Hi, everyone. Welcome and thank you for sticking with us. I know it's been a long day. I'm Ferdinando, or Ferdy, work at LocalGlobe as I was introduced. I'm going to first ask our panelists to introduce themselves. I'm with Parul from Liberty Specialty Markets, Sabina from AXA, and Mervyn from the Association of British Insurers. Parul, do you want to start?
Yeah, I just saw someone familiar. Hi, Ode. My name is Parul Kaul-Green. I'm the Chief Digital Strategy Officer for Global Risk Solutions for Liberty Mutual, which is reinsurance and insurance. And I hold the position of a Chief Product Officer, so I build a bridge between underwriting and engineering so that we are at the forefront of digital evolution within the commercial and reinsurance industry.
Thank you, Parul. Sabina?
Hi everyone, Sabina Kravcak, Head of Strategy for AXA UK and Ireland. So I'm covering two countries, UK and Ireland, and we tend to forget about Ireland, so I can't highlight that enough. And covering a full range of insurance from commercial to retail and also health insurance, and within strategy focusing on short, mid, long-term strategy, any organic and inorganic growth.
Thank you. And last but not least, Mervyn.
Yeah, thank you. So I'm Mervyn Skeet. I'm the Director of Insurance Policy, General Insurance Policy at the Association of British Insurers. I've been in that role very recently, appointed to that role. Prior to that, I worked with Chubb and Excel in the industry, so I've been in the industry for 30-odd years.
Thank you so much. All right, so evolving global risk landscapes, huge topic, a lot to talk about, but we also want to hear from you. So if you want to ask a question as we go along, I've been told that you can use the app, so the Brella app, and just go to the curtain menu and go to the Q&A section. And hopefully I should be able to see your questions and ask them as we go. But let's start with the first question, which is, obviously it's been a huge last 12 months, from war to inflation, from AI to climate risk. How is the global risk landscape evolving for insurers and their clients? And I'm going to go to Sabina first.
Sure. So we at AXA at global and also UK and I level are systematically monitoring the landscape of evolving risk. And specifically, we do it through Future Risk Report. So in summary, this is a global study that we do every year, where we study what are the measures and different changes in perception of risk, specifically when it comes to risk experts, so professionals, and also consumers, therefore general public. So for 2022, just to give you an idea of the scale, we have surveyed 4,500 risk experts in 58 countries, and 404 were from the UK. And we also interviewed 20,000 members of the general population, and 1,000 were UK adults. And I wanted to briefly share with you the key insights, because we can see some novelty there when it comes to emerging risk. So when it comes to the UK risk experts, the top 3 risks they have identified was number 1, climate change, number 2, is geopolitical instability, and number 3 is energy risk. Now, when we compare it to the UK general public, and I'm highlighting this is all UK focused, number 1, climate change as well, number 2, energy crisis, and number 3 is pandemic and any infectious diseases. What I wanted to highlight are 2 key points here is first, energy risks. Since we launched this report at AXA in 2014, this is the first time we see in the UK in top 3 risks in the general public and in risk experts, energy risks. This is a new thing, and when we looked into what are the key drivers for the experts and the consumers, it's understandably the rising energy prices and also the supply problems. But we went further and we asked for the consequences. What do you think would be the implication, what this could lead to? And the general consensus was that this could lead to social unrest or further geopolitical tension. Now, another point that I wanted to bring up is climate change, and I'm sure we will mention it a couple of times in this discussion. But in 2020, we found out that climate change is now second time in a row named as #1 and priority risk for UK experts and consumers. And for the first time, there was a consensus of risk experts in all regions that we have surveyed that is #1 risk. Additionally, when it comes to climate change risk, there was a general consensus that this has a potential to be a risk with the biggest impact on society in the next 5 to 10 years. And globally, there was a consensus that there's only very few that believe that the public authorities are prepared to face this risk, which opens up potential threats and opportunities, which I'm sure we'll discuss later.
Of course. Thank you, Sabina. And it's impressive kind of the reach that you have with that survey and, you know, the huge set of, you know, consumers and insurers that you're able to ask that question to. Obviously, a lot of reach also has Mervyn because it's part of a trade body. What's your point of view on this?
Well, certainly climate's a big part of that. It's impacting coverage in the natural catastrophe space, increasing frequency of major loss events, physical risk, inflation, and higher claims costs are all combining at the same time. But also, I think another risk that we need to focus on is cyber. And cyber, there are major gaps in both ends of the market, actually. So SMEs are struggling with a low level of cyber awareness and therefore not really buying cyber policies. And large corporates are struggling to get cover because the cover is not really proportionate to the risk they're taking on. So with big cyber events, it's very hard to get cover at the top end of the market. So from my perspective, probably climate and cyber are the two big risks that we're seeing. They can both be argued to be systemic in some respects, and that's sometimes difficult for insurance to cover.
Definitely. And we'll talk a little bit later about how we can use technology to deal with these new risks. But before we do that, I also want to focus a little bit more on the kind of differences between, you know, you've got on the one hand big clients of insurers with, you know, extremely distributed supply chains, global issues, global risks. And then you've got the small consumer that is also affected by the same change in economic circumstances and geopolitical tension that you guys have talked about. And I think, you know, with the panel, we have exposure to all of these segments. So Parul, what challenges and opportunities do the current economic circumstances present for some of the customers that you work with?
So we work with really large customers, which are global corporates, multinational corporations, and also other insurers who cede reinsurance premia. And the challenges that are emerging are through the geopolitical tension. There is global supply chains are hugely impacted. So China, which was the factory of the world, increasingly we are finding that all countries are putting in China +1 or putting in propositions around, let's look for alternate trading partners. So that for insurance companies, because we cover marine, aviation, and transportation risk, that is an area where we are seeing a lot of change. Then also higher inflationary environment means that access to credit risk has become really problematic for our insured customers. So that macro risk on tightening monetary policy and availability of credit is also impacting us. And third, and it's mentioned by all of the other panelists as well, is around climate risk. As we cover physical property, both in our insurance and reinsurance book, we are seeing the cost of secondary peril, claims from secondary peril is escalating hugely, which means that because we are indemnifying these risks, we are thinking, can we price them adequately? So price adequacy, emergence of secondary perils, and unmodeled risks are really bringing in a lot of pricing and rating challenges to large insurers. So those are the few of the areas where macro risks are impacted with the current economic challenges.
Yeah, absolutely. And Mervyn, I guess, how do you think the same kind of changes are affecting the small consumer?
Well, of course, we've got across the world a cost of living crisis, but I guess particularly here in the UK at the moment, and that means retail customers are very focused on price, and very small increases in premiums can have a major impact if you're starting from a small base of income, which is a problem. At the same time, many retail writers of retail business have also got significant cost pressures. If we take motor insurance, for example, many motor insurers right now are making losses, and they're struggling to cover their costs, which are also increasing as a result of the cost of living crisis. So you've got this kind of very difficult situation where you've got customers who are struggling to pay premiums, and it's becoming a larger part of their income, but at the same time, the carriers are making a loss. So, anyone in this room who can find solutions to that is going to be a rich person, I suspect, in the near term, if they can find a solution to the fact that customers are struggling to pay premiums, but we're actually making losses as a result of the cost pressures.
That's great. And by the way, if you do find a solution,
please let me know.
I'm obviously part of a venture fund and willing to invest. That's great. And but let's talk, and again, thanks for the plug for venture type topics. Let's talk about technology, because obviously we live in a world, as we've seen, of escalating tension and challenges and types of risks. We talked about climate, we talked about cyber, things that, and Parul, you've said about the difficulty to price, right? How do we build risk models for things where we don't know yet whether our data models are established enough, whether, and where all of the players, are kind of new to this. How can we use technology here to allow insurers to deal with this evolving risk landscape?
So I would zero in on two areas which I think are hugely important for us as entity which takes on the risk transfer. One is the area of machine learning and AI models. Again, we are seeing emergence of huge amount of data sets which are available openly, or they are priced quite reasonably, and how do we augment our underwriting through development of these emerging climate risk models, physical risk models, hazard and asset risk models. How do these models sift noise from signal? Because you can have a data overload. So you need to find what is the data set which is giving you a signal which is helping you to price the propensity to loss. So, and then inputting it systematically and in real time into your pricing models, rating models. So AI and ML in augmenting underwriting is one area which I'm hugely enthusiastic about. And the second area is sensors and connected devices. Now there in sensors and connected devices, real-time data for underwriting, but also as a mitigant. So if you sit down with your risk manager of your corporate client and tell them, okay, if we were to monitor falls or any emerging casualty risks in a particular factory premise through IoT and sensor present there, or in marine transportation when goods are being carried that they don't get spoiled and then claim insurance, can we monitor them in real time as they transit or as they emerge and put mitigants in place? Much like in retail side, you have leak bots for flood risks. So the sensor area is another area that I'm hugely optimistic will bring in real value for insurance and its clients. So those are the two things.
Thank you, Parul. And yes, I think, we've seen it even, investing in technology for insurance. We've seen lots of those examples applied by startups seeking to win those markets, right? Some that come to mind, and, for example, in our portfolio, we have a company called Floodflush, which is essentially, insures flood risk for businesses. And, they put in an IoT sensor in a shop, and then when water level hits a certain threshold, you get a parametric payout, which is kind of interesting how new technology is reviving this old model of insurance and bringing it to new risks. And then on risk models, same with climate. We've got the car in Europe, for example, the car underwriting that are using essentially all sorts of data from satellite imagery to asset data to basically be able to insure climate risk. And it's also kind of interesting, when you talk about the data overload and signal to noise ratio and differentiation, because I think that in established insurance markets, you've got InsurTechs, for example, that used new types of data and claimed that they were going to drive lower loss ratios, and that didn't really materialize as much as it was claimed. And it'll be interesting to see whether for those new types of risk, we will be able to discern kind of the data and the sensors that are actually giving us a real insight into the risk versus not, right? But wanted to again ask Mervyn, how are you looking at technology and kind of give us the industry view on this as well?
To me, where technology can really play a part is trying to close the protection gap. And I think it was also referenced in the previous session, maybe the expectation gap to a degree as well, but certainly the protection gap. The concept of inclusive insurance is something that's been talked about a lot, and whether there's ways of using technology to get to those customers who don't necessarily buy insurance right now, whether that be here in the UK or in emerging markets, if we can use technology to simplify products, to come up with new distribution channels, maybe some digital ways of dealing with stuff, that would be a good way of using technology to really make a difference in those areas where maybe insurance isn't being purchased right now for whatever reason, whether it's linked back to the cost of living crisis we talked about before, or it's just simply that there's not a knowledge of the product or knowledge of insurance in some developing countries. So that, to me, is an area where technology can really make a difference.
Yeah, definitely a good point. And I think, again, examples we've seen as venture investors into the space range from, people using, innovating, for example, in the motor segment with, pay by use sort of insurance policy for motor, to using telematics data to drive, better pricing for customers, to even new ways of distributing insurance that, make it easier to bridge that coverage gap, right? For example, if we often find, despite all of the new insurance brands that are popping up, insurance is still sold, not bought. If that makes sense. And I guess, how do you find new ways to surface the insurance proposition at the point of customer need? And one of those ways, for example, is kind of embedding insurance propositions into customer flows for anything from, the post office to your Monzo account, etc. So lots and lots of ways to reach customers that are not insured yet. I wanted to pause just our list of questions before we wrap up and kind of go to some of the audience's questions that I'm seeing pop up, the unpredictable topics. But one is actually on the categorization of those risks in the AXA report, which is really interesting. The question says, at the ABI 2022 conference, the same month that Russia invaded Ukraine, the risks were categorized differently, with both experts and general public putting geopolitical risk in 10th place. Does it cast doubt on our current predictions? I'm curious, maybe we can ask the member of the audience that asked the question, what were the kind of top risks in that instance? And maybe we can get a microphone to you. Yeah, just 1 second.
Hi everyone, Tom Mortley, AXA Health Strategy Team. So yes, I was at the ABI conference in 2022, just before Russia invaded, although there was some evidence that was going to occur. At the time, it was climate and cyber at the top two positions, but inverted. So if you went for the experts, I think they put climate top, And if you put the general public, sorry, it wasn't cyber, it was pandemics, because that was in the news at the time.
Makes sense.
But that's what I'm wondering is because of such a change in such a short period of time, does this cast doubt on the new composition?
What do you guys think? Why are I guess I've got a personal guess, but just want to come to you first. Why do you think the top positions are maybe changing so rapidly?
If I may give an example from the conceptually, when there is a new piece of information or data which emerges where you are seeing emergence of propensity to loss coming from a source which was not previously observed, then you have to update your triangles and actuarial models. And it may be that this doesn't recur, but with the knowledge available, it doesn't behove insurance company which is regulated not to impute new sets of data which is emerging and causing massive claims. You saw that most of the insurers had underwriting losses, and this year the profits which have come out have been constrained because of the losses which we picked up from the Russia-Ukraine, specifically in aviation, where Russian planes couldn't fly. So I would say that as the new data emerges, because of the importance of real-time and dynamic, and also as I'll use an economic term, if you're an economist, you'll understand, the quantitatifs are changing, and that means the large-scale economic cycle is changing, and if the propensity to a particular claim event has been shown to be not reacting to the historic data, I would say that it's a good thing to impute that into the actuarial model. But that's my view. I'll let Sabina and Mervyn opine on what they feel about that.
I mean, the only thing I would add is that all those risks are fairly systemic, right? And they're bound to be risks that as an industry we're concerned about because we're struggling to find a way to cover them. So the order of it might not be that important, but those two or three risks at the top would make a lot of sense to me, given they're very difficult risks to cover at certainly the top end of the market.
I agree with everything that was said, and I think here in this report, what I really like that we're capturing the risk experts and also the consumers, and I think and there'll be more questions about our relationship with the consumers, but seeing how far and how quickly it went on the consumer side, I think it's an indication to us as insurance professionals how quickly it can penetrate the general population and what it means for us.
Yeah, I think I would agree. I think it's interesting, and I think that the results of the survey change as quickly as the situation is evolving, right? We live in a world where our kind of mind is preoccupied with a new risk almost on a constant basis, and it felt like the pandemic felt like the first of many crises, right? We talk about a multi-crisis world and dealing with risks as they arise. Obviously, climate has been a constant, but it feels like with the war and the regulatory decoupling between the UK and the EU, the trade war between the US and China, there's always something new that is pushed into both the mind of consumers and businesses. And this is something that we notice not just from, I think, an insurance perspective, but also, we're a journalist fund, so we always think about what are challenges that technology can solve, and I think they change. Right now, they change on a weekly basis, right? It's possible that the latest developments even in the past month with AI, there's probably a new concern in the mind of consumers and businesses that wasn't there in the report just a few months ago.
Exactly, like that's a fantastic point that I was thinking about when I was thinking about this discussion is a generative AI. And also the simple thing of economic instability, it's part of the top 10, and it was when the report was published. I would take a wild guess that at least on the consumer side, it would be higher today.
Yeah, I agree. Okay, we've got a few other questions. Talk about one thing on the protection gap. Global food scarcity has doubled since 2020. Yet we don't insure most farmers or their crops. The protection gap is too large. With climate change making it worse, what can insurers do? Any of you to talk about farmers and crops and...
So ag risks, some of the ag risks, and I was in Aviva, AXA till 12 months ago, we covered the crop failure risks in the parametric product. So that agricultural risks and crop failure risks are covered. But increasing severity of climate events and the devastation to the crops means that we have to think more imaginatively what kind of coverages we can offer to support the global food security. The global food security is also supported through marine transportation. So when I gave you an example of sensors being used for coal transportation and wheat and all the soft commodities which get transported, which are all insured. So these move from country to country, and if you saw in the Ukraine crisis, some of the countries which were the worst hit was Middle East, Egypt, Lebanon, which had no food stores of their own. So insurance companies can support, because we support global trade and global marine trade, there is a role that we play in mitigating some of the implications on the global food security issues from geopolitics, also from climate crisis. But we will have to be more imaginative, and also because we are in the end an enterprise, we need to, and we make really small margins, so we have to think about how do we mitigate these risks, support these risks in other than risk transfer measures as well. Can we give adaptation and resiliency advice to farm corporations and institutions which support farmers and other multilateral bodies like United Nations food programs? Some of the insurers do cover the UNFP programs as well. So there's many layers of how we can help on food security and multiple ways of doing so as well.
Yeah, I would agree. I think, and this is also a question that goes beyond insurance, right? I think with farmers and the economics of farmers stacking up, there's new ways thinking about the challenges of climate change, for example, to support farmers through things like regenerative agriculture and the ability to generate carbon credits off of that, for example, and that can be another revenue source for farmers or restoration projects, and et cetera. So, you know, it's a wide question with many answers, and insurance is definitely one of them. Conscious of time, wanted to get back to our question set. This is a big one, but conscious of all of the challenges we've talked about, and we've only talked about some of them, and the opportunities, you know, both through technology and other things that are there for insurers. What relationship should insurers have with their clients in this increasingly riskier world? And I'll come to you, Sabina, again.
Thanks, and I'll take it a little bit from macro level and bring it out to more specificity. So anchoring back at the report, what we saw in the report, the main thing is that we see that consumers, specifically in a large UK population, is feeling that they're coming increasingly more vulnerable in the risk that they are facing and that are just happening externally around them. And what we have also seen, that there is a very limited confidence in the public authorities or private organizations being able to mitigate those risks and collaborate together to find a solution together. Now, this is where insurance come into play, and actually insurers have a great role not only in the financial services industry but in the society overall, where they can provide a reassurance to consumers who are vulnerable, and they can provide that feeling of safety and help and support to protect against a wide range of risks. So this is one part of the relationship that we should not forget about. Additionally, what we have seen in that report is that the consumers do recognize the safety net that the insurance provide, and they do recognize the benefits of having the protection. However, also to what you have mentioned, there are still some consumers and groups of the population that are not fully aware of yet of the benefits of having a protection and how it can actually help reduce the feeling of being vulnerable. And I think with insurance have a great opportunity to raise the awareness of what it means to protect against a wide range of risk and how we can prevent the risk also at the corporate, commercial, but also at the individual levels, and how we can actually help the entire society. So in conclusion, when it comes to what kind of relationship we should have with consumers specifically, I think first, it should be us raising the awareness. Second, being also relevant. We have discussed many risks. We're talking about evolving risk, being on top of the game when it comes to what are the relevant risks to our consumers is key. And third, being reliable. Once the trust is put in us and the consumers do want to work with us, we need to prove through our really resilient and robust operation setup, our customer experience, which is seamless and simple, to demonstrate that we are there for them and they can continue trusting us.
Thank you, Sabina. And I guess it goes, a lot of those points resonate, especially with, I guess, the consumer mindset, right? Because it really is about that kind of awareness that that is often lacking in the financial education point, as well as building that relationship of trust. But actually the point on relationship extends far beyond that size of consumer, right? And Parul, it extends to the type of customers that you guys have, these huge, multinational corporations, and also the type of relationship with them is pretty special, because I know that, you guys, for example, in the way that you take risk. Can you talk a little bit more about that?
Yeah, sure. So again, it's the commercial large corporate risks are intermediated, so we will also have impartial advice from our broker colleagues. So we work in what they call a three-legged stool. It is a known term in commercial insurance, with the insurance company, the risk manager of the insured, who is probably sitting in the CFO office, and sometimes they can have 80 to 90 people working in that risk management team, because they're managing enterprises' operational financial risks. And then we have our impartial advice coming from the brokers. So when we sit down with the risk managers, they are increasingly asking us to work with them on the entire cycle of risk that is within the enterprise. It may be the physical risks to their properties, so they have warehouses everywhere. What kind of risk management practices should we have? What risks should we mitigate through these risk management practices? What should we be transferring to you as the insurance to indemnify? And what should we be retaining on the balance sheet, and also understanding, even with the retained risk, what kind of capabilities around adaptation, resiliency we could be putting in place such that they're able to manage these risks. And then there are risks which are emerging risks which come in, and opportunities which come in. Say, for example, you must have heard of Joe Biden's Inflation Reduction Act. Now, Inflation Reduction Act is one of the largest it's got trillions of dollars which are going to be funded through this into energy transition and managing climate risks. So we are working to understand what that means. There are infrastructure projects which are going to be funded to really develop the US infrastructure, in-source some of the critical resources such as semiconductors and energy, alternate energy resources. All of these require for us to, as risk managers and risk engineers, to understand what does that mean in terms of how a propensity to claim will occur, how these should be deployed. So when we are giving advice on environmental risks through our risk engineers, we can also talk about what should you place as you build this plant, and how should you get this funded, what should be the the ideal combination of retained risk versus transferred risk versus mitigated risk. So we are increasingly seeing a demand for having a very tripartite negotiation for larger risks, where insurers are in the room with the CFOs and CROs, giving advice, of course, always intermediated, because they want impartial advice, and we love our broker partners because they bring us these opportunities. So plug for brokers.
That's great. Thank you. And Mervyn, I guess obviously with AXA and with Liberty that you've got that kind of direct relationship with the customer. But from a trade body perspective, what do you think is the industry view on how that relationship is evolving given these new risks?
Yeah, I think I pick up the point that was made a minute ago that you need to think about loss prevention and loss mitigation. If you work with your customers, whether they be retail or wholesale customers, then they'll have a better understanding of the risks you're looking to cover, what's covered and what's not, which is pretty important. We referred earlier to the expectation gap. It's very important, I think, for customers to know what they're covered and why. I think it's important to understand your customers, whether it's retail or wholesale. What are their real needs? What are they looking for? What are they trying to buy? We've had issues in the industry over the last number of years around business interruption. We could have it again with cyber. There are other areas we've got to be very, very careful to make sure that the customers understand the risk they're buying and why they're buying it, and whether it's right for them to buy that policy.
Yeah, definitely. And I think, again, from a technology investor perspective, we've seen, for example, the first wave of InsurTech was all around bettering the UX. And I think a big point there was around making insurance simple and accessible. And, maybe those InsurTech innovations didn't deliver quite yet on the loss ratios. But one thing that they did demonstrate is that it is possible, through mobile, through new interfaces, through new distribution avenues, through just simple language, to innovate on the way that customers access insurance. And so that's something, we've definitely seen. But thank you so much. I think it's nice to kind of end on, as we kind of run short on time, to end on a note that's kind of, we've gone through, this kind of hellscape of risks that is surging and coming towards us, and affecting consumers, affecting businesses, affecting insurers, affecting the way that we price risk. And we talked about all of this complexity with new technology and using that to navigate this landscape. But I think it's nice to end on the relationship note, because ultimately that's still the core of what you guys do, right? To have that close relationship to the consumer, to the business, to the insurance partners. You talked about brokers, but there are, reinsurers, others, and kind of, it's that whole ecosystem that in the end leads to hopefully better risk coverage, innovative risk coverage, and, better coverage gap, bridging the coverage gap as well. So yeah, thank you so much for speaking with me today, and I'll close it there.